Let's face it, investing in private funds hasn't really been something that most investors have been able to participate in. Traditionally, institutions and very wealthy individuals have had near exclusivity in this market. But today, things are changing. We'll discuss why that is and how you could participate right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for being with us today. Dan Scansaroli from the Chief Investment Office is back in the studio with me. Dan, good to see you.
Good to see you, Anthony.
This is a complicated topic for a lot of people. And as I said in the beginning, traditionally, it's really only been institutions and really wealthy families and individuals who've been able to participate. But in the last year and a half, there's been a bit of an evolution when it comes to private equity funds, especially sponsors making it easier for the non-traditional investors in the space to participate. Maybe you can discuss the structure, the new structure that's out there, and how it, maybe you could say, democratizes access to the space, which again traditionally has been reserved for the bigger institutions and really wealthy folks.
Yeah, as you mentioned, there has been a democratization here, and in order to understand that, we have to start where we've been historically. Right? Historically, the way in which most investors got access to private equity in particular, but private investments, was through what we refer to as a drawdown structure. And in a drawdown structure, there's usually a 3 or 6 month fundraising period where they're taking subscriptions, engaging interest in launching a new vintage year of a fund with certain objectives in terms of where they see opportunities in the marketplace. After that fundraising period is done, that's when the individuals are committing their capital to be invested. And when you commit that capital, that, as the name implies, is a firm commitment that you have to deliver on any capital that they call. And that's one of the primary features that made it challenging for average investors to get access to the space, in addition to high minimum investments. But where these institutions, what they've had to deal with in these drawdown vehicles is during the first 3 to 5 years of the drawdown structure's life, you have what we refer to as an investment period, where you're getting capital calls on an unknown schedule, where you have to immediately turn around and provide that capital from that commitment so that they can be put to work in the opportunities that the general partners and the fund sponsors are finding in the private market.
Right.
Then after that, for the remaining 6 to 12 years, depending on the strategy, you get distributions, what we refer to as the harvest period. And those distributions also are at an unknown size or frequency of when they're going to come back. And so it creates some challenges in terms of managing what we refer to as a J-curve. A J-curve being capital calls, negative cash flow in the beginning, and then it takes time until you accrete that value from the investments and actually see positive cash flow from this. The evolution that we've seen in the space is a new legal structure that, instead of having a drawdown, it's referred to as a perpetual or evergreen fund structure.
Right.
And legally what they're doing is they're wrapping, in almost like an umbrella, all of the different drawdown vehicles and all those portfolio companies in this one fund, and there's no capital calls. Your capital gets to work on day one. There's monthly subscriptions to get your capital to work. And they offer enhanced liquidity, typically quarterly liquidity in order to redeem. But as the name implies, evergreen and perpetual, what they're doing is they're picking up the operational complexities of dealing with a single vintage years drawdown fund, and they're building a diversified strategy across multiple vintage years where they're managing the cash flow to recycle the distributions into the next deal that they see come across.
Right. So this is essentially a structure that's allowing the sort of non-traditional investors to kind of get in here. But what would you say then, Dan, when you're looking at these perpetual structures? What's the risk? What's the trade-off here? Because it sounds like there might be something in there.
Yeah, there's definitely a trade-off. So I mentioned before that the drawdown structures tend to have high minimums, usually a minimum investment of about $250,000 to $1 million to get access. Here, a positive trade-off is typically we're seeing anywhere from $10,000 to $100,000 minimum to get access to these perpetual vehicles. So what are you giving up for that? And you're getting your capital to work immediately versus waiting for it to be called and put to work, and then waiting for the distributions.
Right. Sounds like a dream.
It does.
So, but if nothing is perfect.
Nothing is perfect, and really where the trade-off there is that enhanced liquidity that you can get on these funds. It is not guaranteed. Contractually, they typically structure it that you can redeem on a quarterly basis, but there's typically a cap to that redemption. The cap is not specific to you. It's specific to the total number of redemptions relative to the asset size of the fund, where the typical cap is about 5% of the total assets during any given quarter. If they are redeemed, the fund has the ability to scale that back to the 5%. And distribute on a pro rata basis. So if there's less than 5% total subscription redemptions for the fund, you're likely to get your redemption in full back during that period. But if it's higher than that, you may get a lower portion of that. So you really shouldn't rely on this for liquidity. The other trade-off here is that in order to manage the cash flow for you, taking on that operational complexity and this enhanced liquidity feature, they do have to sit on a level of cash in the account. Usually anywhere from 5, even up to 20% of the allocation will be in cash, depending on the opportunities that are coming up in order to deploy that cash in the redemptions that are coming through. The third trade-off is one that is a double-edged sword. It both is advantageous, but also can be a little challenging, which is these are still long-term investments. And so if you treat that liquidity feature as if it's not, you can really disrupt the illiquidity premium that you're going to generate here, because you're getting in and out of these funds, not at the inception and when they exit, but you're getting in and out at the net asset value, which is the appraised value of every portfolio company. You're getting access to all of them on their books at the appraisal value. Same thing when you exit the strategy at the appraisal value. So if you don't get the full life cycle of several vintage years that are underlying in terms of those portfolio companies, you're unlikely to maximize your return potential.
So Dan, something you had mentioned in the previous question was talking about how perpetual fund investors, they literally get their capital to work on day one, but a more traditional fund investor, they have to wait for a longer period. So how do you then compare the returns of both of those?
This is a critical question that comes up quite often, because when you think about the traditional investment in private equity, the portfolio manager is making a decision on when to put their capital to work. And they're going to pick portfolio companies that generally they underwrite an internal rate of return, somewhere between 15 and 25%. Now, internal rates of returns are not total returns. Because we're waiting for capital calls and then we get capital distributions, the amount of that capital that you committed that's at work at any given time is a lot less than your commitment. And the unfortunate reality is that most investors who go into private markets, because of the uncertainty of those capital calls, they wait in cash for those capital calls. And then with the distributions, they have to make a choice in terms of how to operationally manage that. And that's one of the advantages of the perpetual vehicles. They're doing that for you. But they typically will distribute it to, let's say, a public market equivalent like the S&P 500, right? But when that capital is to work in the private markets, on average, you're getting that 17% rate of return for the portion of capital that's at work. So how do we think about that in a total return space, which is how we need to compare it to these perpetual vehicles, because they are getting your capital to work on day one. And generally, if you're waiting in cash for capital calls and you're distributing to equities and you get the long-term average somewhere near 10% on equities, a 17% return for the private equity, and somewhere 3 to 4% on the fixed income. And when we look at this illustrative example, we find that over an 11-year time period, the typical investment period for a drawdown fund, you generated basically a 3 times multiple on your capital. If you translate that to a total return, that's about a 10.5% return, which is not 17%, right?
Right.
Now, if we then switch over to the perpetual vehicles, what are they doing? Well, they're getting you in at the net asset value, the appraised value of every single portfolio company, some older, some newer, different vintage years. And that's what you see in the rainbows on the chart here. But and they have some level of cash in order to manage the capital calls, distributions, and potential redemptions, but they're keeping you steady invested in different opportunities in perpetuity. And the way that they're doing that is they're recycling the distributions into the next deal, in addition to getting the capital to work on day one at the net asset value. And so if we believe that because you're co-investing in the same portfolio companies as the drawdown funds, if we believe that we're still going to get that average 17% IRR, the power of getting your money to work immediately and then not having to deal with the operational complexity of recycling into the next deal over that same 11-year time period, instead of getting a 3x multiple, this illustration, we get a 4.2 times multiple, which translates to a 14% annualized return. So the total return expectation is very different in terms of your funding source and the way in which you're dealing with your distributions. And that's what the perpetual funds are doing for you. They're taking on the operational complexity, they're reinvesting in the next vintage year, they're managing the distributions so that you stay invested at a high level.
Right. What about, so the last question, and we only got about a minute left. For those people who are watching the show today, and this is interesting, and they're thinking about adding private investments to their portfolio, which we've talked about in other forums, here with your team and yourself, Dan. How should people be thinking about that when it comes to their asset allocation? Because we always hear about the 60-40, the traditional equities, bonds, but it's different now.
Well, to start off with, whenever you're considering allocating to private investments, you need to evaluate what your illiquidity tolerance is.
Right.
Even though we have these enhanced liquidity features, that liquidity will likely dry up when you need it the most, particularly during bear markets, right? So thinking about your spending policy and right sizing it. Now, that being said, many investors do have a portion of their assets that they're not going to need to touch for longer time periods, and generally that's where we think that you should consider adding privates to your allocation. When you're adding privates, it's not ubiquitous in terms of what the allocation is. Just like when we look at public markets, we want to look at your profile. What are you trying to achieve? If you're more income oriented, you're going to orient much more to private real estate, private credit, and private infrastructure. If you're more growth oriented, private equity, whether that's growth equity, whether it's buyouts, funds, or even secondaries, and sometimes even venture. In almost all of these spaces, you can actually find these perpetual vehicles to get the lower minimums that I mentioned before, to form a more well-diversified allocation, which is really the democratization of being able to build a diversified allocation.
Where we started from the beginning, talking about the democratization that we were, when it comes to this type of investing.
Exactly. So when we look at those income-oriented or those growth-oriented or a balance in between, those different types of 100% privates portfolios that can be slotted in for a portion of your assets, historically, when we look over the last 15 years, we find a very meaningful premium above a stock bond mixed portfolio, whether that's on the more conservative or more on the aggressive side.
Right.
And so, when we look at the current market environment, we look at the easier access to these perpetual vehicles. When you think about that 60-40 portfolio that you mentioned, we believe that the new 60-40 is something along the lines of a 40-30-30. That last 30 being in alternative investments with the right orientation. Right. If you had gone from a 60-40 to a 40-30-30 in the last 15 years, and you've been well diversified across different managers and different vintage years, generally that would have delivered 120 basis points additional return above a 60-40 portfolio. That's 1.2%, and you would have had 1.8% less volatility. So much more efficient, a smoother ride with greater compounding over time, lower drawdowns as well. And that extra return per unit of risk really is what we're focused on from a diversification perspective.
Yeah, those numbers, Dan, they're very compelling. So thanks for sharing that with us. Good to see you, Dan Scanscaroli. Thanks for coming by.
Excellent.
Great. And for more information, please visit ubs.com/views. That's our Insights website. All the information that Dan just spoke about, plus lots of other content from the Chief Investment Office is there for you. Plus, you can follow us on social media. We're on all the major channels, including Instagram. Follow us at UBS Trending. Lots of content there for you as well. And look, we know this is a very fairly complicated topic, so make sure you're picking up the phone or emailing your financial advisor to continue the conversation there. Until next time, I'm Anthony Pastore. Have a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.